BitShop, the first fully privatized on-chain auction house, introducing new ways to generate liquidity for Web3 assets, backed by KuCoin Labs and Republic Capital. Bid small, win big at BitShop.io.
Good afternoon, everyone. BC Richfield here, coming to you live from London. It's just gone a couple of minutes past midday, making it just gone 1100 UTC. Big shout out to everybody that's on the stream already. See a lot of familiar faces in there. Good morning, or good afternoon, wherever you are in the world. And a big shout out to everybody that's watching this on recording as well. So, who have we got this morning? Saw MN was in early as well. Erica, great to see you guys. Craig, obviously Nitpar as well. GOT, hello to all of you legends and everybody else. And anybody obviously that's new to the stream as well, don't hesitate to say hi, guys, and we very much welcome questions on here as well. So hope everyone had a lovely weekend. MM's in there, nice liquidity grab ready for FOMC. Sebster, good morning, buddy. Yeah, absolutely. Got a very news-driven week coming up this week as well, guys. So do make sure to keep an eye on your economic calendars. I had someone kind of bring this up last week as well, saying, look, Bitcoin really hasn't been that correlated to traditional markets recently. No, absolutely agree with that. Actually, you look at the correlation between the DXY, the dollar index, and risk markets in general, it's kind of waned a bit because we've been stuck in this kind of like what seems like quite a never-ending range for Bitcoin. But it's still very, very vulnerable to big news releases, right? And the FOMC one is going to be really, really big. Good morning, Ricky, Ilcho, Rock. Oh, nice. Very, very nice. Yeah, well, hello from a very gloomy London, unfortunately. I wish I was somewhere a little bit more tropical to report. But yeah, we love moaning about the weather here, don't we? Lil Bar, welcome. With price action like this, what counts as confirmation? Is it just what time frame candles close or what? Yeah, absolutely. Actually, there's very different ways to look at that, depending on what type of trader you are. Some people that focus very much on traditional kind of support and resistance levels and volume. People like the Trading Tank, Jay, fantastic trader who trades with us, really crushing the legacy markets. I think he's got 100% record this month on legacy calls. More of a swing trader, right? So at the moment, it's not really the kind of environment for him, crypto. Not a lot of swing trades available, more one set for the low time frame traders. But someone like him, he's very much based on working out key support resistance levels and then looking for closes of higher time frame candles above them. For me, in terms of confirmation and how I see it, I use it confirmation in a kind of different terminology, really. I'm not per se looking for closes as such. I'm looking for inefficiencies in the marketplace and liquidity. So liquidity for me is resting above old highs and lows. Inefficiencies sit within our fair value gaps. We can see, to give an example, the one we've got on the page at the moment, this one. Now we can see that this inefficiency was left, right, when we had this big drop down here. And the other thing that I really like to see if I'm looking to trade this is inverse fair value gaps, right? So this was a bullish fair value gap when we looked like we'd reclaim the level. So other people would be looking to kind of trade this higher. For me, what I'm looking for is I'm looking for the inefficiency it's left as it's gone. And my terminology for confirmation is I'm waiting for a confirmation setup to appear in here, meaning that if we took this and extrapolated it onto a lower time frame, yeah, then what I'd want to see in here if I was going long is I'd want to see this move come into this area and then trade higher, right? So I'm not just going to set a limit order there. Now, if we zoomed in on that, what would that look like? Well, I would want to see price coming into a key level. I'd want to see a sweep of that level, a recovery, a retest, and then I'd be looking to trade higher, yeah? And within this impulse leg here, I would want to see a fair value gap that I can retrace and get as a target entry, right? So we didn't get that here, but we got the bearish equivalent. Now, what happened there was that turned this into an inverse fair value gap, right? Meaning that we didn't get the bounce. What actually happened was price just continued straight down, meaning that then when we return to this, which we've done here, we're favoring short setups until we can reclaim it, all right? So for me, that's how I would be discussing a confirmation setup. So just to show you that quickly, Lil Bar, apologies if I'm pronouncing your name wrong, is I use time of day is a big factor for me. So when price retraces into an area like this, I've already got my bias, right? My bias is bearish. So my confirmation setups would come here and then here. And let me show you why that is on a lower time frame. And let me just pop the session breaks on as well, so that we can just see the day dividers, okay? So we can see we've got this arrow here, right? And then we've got this arrow in here. Now, while I would typically trade this from a 5 minute down to a 1 minute, I do understand that a lot of people don't kind of trade those time frames. Great shout, Erica. Always reminding me of the good stuff. Well done. Thanks for that, bud. So here I'm short bias, right? So when I say I'm looking for a confirmation setup, I'm just looking for the same thing again, but on a lower time frame, right? So at the moment, this is bullish. So remember how I said we're looking for a bullish fair value gap here. Bear in mind, we're bearish, so we're not looking for long setups. So we get this bullish fair value gap form. That's then violated with a strong bearish FVG here, yeah? So then what I'm doing, just in terms of the rules of price and time, I've got my fair value gap here. So what I'm doing is I'm then hunting for short setups in here. What we'll notice is we didn't actually get a setup in here, right, on the 15 minute. You're welcome, Erica. Because it didn't retrace. But when we look at this example here, we can see that we did, right? Because this, for me, I like trading the New York session, so I run that up to 10 p.m. UK time. So I want to see my setups for New York forming in this kind of area here. So I've still got a bearish bias. Why? Because we tried to get out of this fair value gap. We're now back within it. Remember, like I just said twice already, right? We've seen a bullish fair value gap here, violated with a bearish fair value gap, this smaller one here, meaning I'm now seeing this as resistance, right? I'm then looking for a bearish fair value gap in the form of that to then frame my short setup, yeah? And if I was looking to take that on a 15 minute, I'd be looking at this displacement leg here, favouring shorts from the upper 50%. So I target the fair value gap that's in the upper 50%, which is here. My short position takes place when price retraces to this fair value gap. My stop loss goes above it. And then I need clear and obvious liquidity target lower. For me would be this first of all, right? This clean swing low. And then ultimately the mother bar low down here. Okay, so I just wanted to take a little bit of time to run through that. Apologies if I know I've gone over it a few times with people, but I know we get a lot of new people come along on a Monday now. So that's the kind of premise of how I would look at that little bar. So I think hopefully that was clear enough for you. Apologies if I rushed through it. I'm happy to go through it again. But you can also find a lot of these setups. They're all the same, how I share them on Twitter as well. So let's just delete that and get ourselves back to a nice clean chart. I know I've got a couple of questions coming in, guys, so let me just tidy this up for a moment and then we'll jump back on and take a look at those. Brilliant, awesome little bar. Honestly, mate, if you want any more or if anybody does have any other questions like that, please don't hesitate to ask. It can be really, really useful for other people as well. And good for me as well. Nice to kind of run through it. Excuse me for a minute, I just do something very British and take a sip of tea. For those of you tea lovers out there today, I'm actually on a little bit of green tea and lemon. I had a very early start this morning, so I polished off about 7 cups of breakfast tea. So I thought I'll purge the system out in a bit of style. Right, so let's just pop this back to a 4 hour for a minute. Let's look at a couple of questions. And then we'll kind of zoom out and do our top down, yeah? So this is a really, really good pattern to get used to spotting, guys, as well, right? You know, because even as we've got this here, right, this is represented all over the place. We set a high, a low, a higher high, swing fail, meaning we've taken liquidity above these. We then break this low, yeah, shifting market structure, yeah. Then we return to this inefficiency to trade lower, and we can now see this playing out. I actually shared this on Twitter last night. It's my belief that price action is going to do this. I very rarely trade Monday. I really like to see how Monday's range develops. I trade, traditional markets as well. So Monday's always a very tricky day while the market's getting set, especially in any news-driven market. But when you see these kind of patterns, you can see that they do play out quite regularly. So it's always a good one to spot. So let's just take a couple of look at some questions. Yep, full screen, really good shout there from Erica. Could a confirmation setup be faked by large traders or manipulators? Yeah, so basically, Net, let me just pop you a question on screen here. Yeah, so fake outs, and that absolutely can. But actually, what the fake out is what we're kind of attributing to market manipulation, right? So what we're actually looking for, and for those of you that aren't aware of this, it's not kind of some big conspiracy. It's how the markets work, right? You have these huge commercial entities, which you can attribute to someone like ICT, for example, would say smart money, which is basically a collective of the biggest, brightest minds and the biggest institutions that can really throw their weight around. But we're all retail compared to these people. These people are trading with billions and billions of dollars, right? So let's just use the current range we're in as an example. Yeah. So if you want to fill a large batch of orders, yeah, then the best way to do that is to send the market in the wrong direction. Okay. So, hey, Yakuza Kana, hey, buddy. So how do you do that, right? And why do you see so many of these swing fails? Let's just for the fun of it, we just pop this on and let's just kind of highlight the key liquidity on this chart. So first of all here, why is that key? Equal lows, right? There's equal lows there, which is just massive. So let me just, actually, I know why, because I've got that on, haven't I? Let me just change this to red and make it a little bit thicker so it can stand out for you guys. This is a really, really good study. I'd always recommend anybody do this. Go and look at your swing failure patterns. Go and look for it. So swing fail, for those that don't know, is when you set a swing high or low. So see this swing high? Then you get a move that goes beyond it, fails to close above it, comes back within it, and then sells off, right? That means that the target above there, two things in my mind. One, price failed to achieve acceptance above that level, yeah? Meaning if there was acceptance above that level, yeah, then we would have more buyers. The next thing it means is that price has been pushed up there in order to trigger, see this big long wick, price has been pushed up there in order to trigger the buy stops that are above there, yeah? Now, why do we say buy stops, right? Because people that were short here, they're short in trade, but their stop loss becomes a market buy order, right? So why is that important? So above here, before we tag this, before we tag that area, people know that there's stop losses up here, right? You don't know how many of them, for example, but they're buy orders because the people here were short. So let's just put this on here just to demonstrate this. Say you had some people here that were going short, right? And their plan is to short this thing right down to here. Now, what happens in here is you get this accumulation of buy stops, yeah? Meaning that they're buy orders that are market executed. So if you want to get a lot of your orders filled, the problem that you've got is if you just open $1 billion worth of orders here, the market's just going to plummet. And what that means is that you get slippage when your orders get filled, meaning they don't all get filled at that price because the liquidity just simply isn't there. So what you want to do is you want to create this mass liquidity pool, yeah? And this is all done through algorithmic trading, etc. now. But the best way to do that is to target the liquidity resting above old highs and below old lows, yeah? So what happens here is when this move is manipulated, our assumption is that the market's being manipulated up in this direction. We see that we get the swing failure of this level, right? Why is that significant? Because now price has gone up here. It does a few things. It hits all these people's stop losses, generating a lot of buy orders. It also triggers breakout traders and breakout algorithms that then open more buy orders. So let's say, for example, you've got $100 million worth of buy orders there. Well, that might just be one institutional order placement, right? Or two. They can then fill that here, right? Flip this from buy orders, which was sitting in green, to fill their sell orders, and then you get these big market flushes. All right. So that's the principle behind it. That's the manipulation that we're looking for. So when we think that way, and this goes back to Nick's question, what we're actually trying to do is we're trying to align ourselves with institutional order flow, meaning that we're trying to get on the same side as the big players, as the people that can manipulate these markets, as the market makers, right? So that when we're trading with that bias. Yeah. If we were a breakout trader here, we'd have been trapped, caught on the wrong side. Our stop loss would have been hit and we'd have been out. It's not saying that breakout trading doesn't work. It's just that we all have our own kind of view on the market. And for me, it makes a lot of sense that these markets and the players that have the money to move them are able to do exactly that. So a good way to study that is to look for key liquidity. What is key liquidity? For me, it's clean and clear and obvious highs and lows, right? So clear and obvious highs and lows. Where are they? Here, right? Where else? Here, because they were equal lows, yeah? Where else? Here, 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 here. You see, basically, you'll hear a referral if you study ICT, and a few other people talk about this as well, as internal and external liquidity. Now, if we're looking at this range, which is our inside bar range, right? Range high, range low. External liquidity, yeah? Meaning that if price runs these areas, they become really key points of interest. Let's look at when that's happened, right? Price ran liquidity here, ran liquidity here, but remember this is external liquidity, here, here. Now we've got this, right? So, deviation, deviation, right? Oh, if I draw that one the right way around. Yeah, I'm not going to go on and do the rest of them, but you get the point, right? Now, when we're talking about deviations, what we're talking about is price trying to get in one direction, failing, coming back within, and then facing a sell-off. Yeah, so that's something that we can target. So when we're looking at the charts, we can look for our external liquidity, which are these clear and obvious highs and lows, and study what price does when it interacts with it. Remember, we said about this one. Well, look what happens when we engage with that here. We also engage with this one, which is internal liquidity. Why is it internal? Because it's within the external liquidity, yeah? So the same way as if we just broke this down as a range, we'd have our external liquidity here and here. Internal would be this low, this low, this low, this low, right? It doesn't mean that we don't get a reaction when they're run. It just refers to the time frame and the significance that we place on it, okay? So a good thing to do when we're studying liquidity is, mark out these old highs and lows, yeah? See if price really has that much of a reaction. Look at this internal liquidity. Yeah, price tagged it here. We didn't get much of a response, did we? We tagged it again here, but actually this had been run at that point. So the reaction that we got here was off of this liquidity down here. So let's do a little exercise in how we can kind of look at this. Let's look at these. Let's draw a little red box around these key liquidities, yeah, around these deviations. And then let's have a look how price reacted and what we can do to take placements within that reaction. Yeah. Let's tag this one as well because of the equal lows. And I'll just pop this in here just to signify that that's what we're dealing with. Because for me personally, equal lows are very, very important, or relative equal lows. They don't have to be exact. But it's looking for kind of engineered liquidity pockets, right? Clean and clear areas where you've got the price market has stopped there for a certain reason. When that gets run, it becomes a really key point of interest, all right? Like here, for example, we had this impulse move higher. Just zoom in a bit. We had this impulse move higher. When price dipped into this fair value gap here, yeah, we see this immediate strong reaction. We want to look at the reaction of the candles. We want to be able to study the dynamics of the movement, right? When price reacts really strongly like that, it tells me that there's buyers in here. Then when we see this big expansive move higher, immediately when we get back to that level, which we do here, yeah, look at this reaction that we get, yeah, because we can see that we had strong buyers there before. Even when that liquidity is run, we then move that down lower. We see another strong reaction when we get here. Now we've run this, we see that the price is getting bought back up again. Yeah, people taking profit, etc., but also filling buy orders for people that are long down here. So by studying that, we can drop down to a lower time frame, right? And let's try the 15-minute first of all. And then all we're going to do is we're going to go to our red boxes and we're going to say, okay, did we get any entry triggers? Andre Britz, good to see you on the show, my friend. I'm actually BC Richfield. I'm one of the technical analysts for the Nest, so not actually Mr. Burb himself, but you're very, very welcome to the stream, and I hope you enjoy it. So, looking at this here, however you would trade this, whatever your entry methodology or techniques, yeah, we're talking about looking at this strong reaction. Look at this long downside wick, yeah. So ideally what we want to see in a setup is a sweep, which we see we've got a local sweep here. right? And then you'd want to see a break of structure, or personally, I would. So what have we got here? Low, lower, higher, higher, low, yeah? So on the break of this, all of a sudden, we've got an ability to go long. Now, depending what your entry methodology would be, if I was trading this on a 15-minute time frame, I'd be taking this displacement leg, right? Favoring, making sure that I've got my long setup triggered in here. I'm looking for a fair value gap that lives down here in discount, which is here. Make that green to show that it's bullish. And then, as I said to you with the last execution, your entry would go on here. Your stop loss would go below the price swing low, which is here. I always put it a few pips below. And then I'm looking for clear and obvious liquidity again. Look how we've got all of these untapped highs leading all the way up to here. Yeah. So you want to make sure that if you're taking the easy and obvious target, so for me, I'd be looking at these ones here and saying, okay, well, if I'm wrong and the market reverses, I've had the opportunity to, first of all, move my stop loss to entry. So I've no longer got any risk, and I can trim a little bit of profit, right? What would happen here is you would take some profit off the trade. Ultimately, the trade fails, takes out your stop loss at break even, and then you have the ability to make a little bit of money and also reduce your risk at the same time. So I hope that makes sense, guys. That's one that we'll look at. Let's just look at a couple of other quick examples as well. So as we drag ourselves back, I think we've got one on the high side up here, haven't we? Yep. So I always just like running a couple of these, and I always like using recent data. No problem at all against people that use PowerPoints and other data. They make some really amazing stuff. But for me, the reason that I do this ad hoc is because I like you guys to see that this is real data, that it's not cherry picked, that we can look at trades that have happened. This was from the 14th of July, for example. This is from 10 days ago. The other one was from even more recent. Yeah. And it's really, really important to understand that when you're testing yourself as well. Yeah. Don't just kind of cherry pick the stuff. Otherwise it can get a little bit misleading. So here we are again. We've got our deviation. What do we want to see? Price come back within the range, which we get here. So remember I said on the other one, we wait patiently. So we have this move, have the sweep. What do we want to see? Yeah. We want to see a sweep. We want to see a break of structure or shift in structure, which we get here because of this swing low. Yeah. High, low, higher, higher, down to a lower low. Yeah. And then within this body here, which is the displacement leg, just need to reverse that so that everybody can understand that actually we're looking to short from premium, which is up here. And what do we get? We're looking for one of a few things, fair value gaps, which is what I favor. Yeah. But if I don't have a fair value gap in here, which I don't, then I need another trigger, right? So for me, that has to be an order block or a breaker. Yeah. In this case, I'm going to use the breaker candle. So we've got the high volume candle here, the up candle that led to the sweep of liquidity. I do those in orange. I'll now get rid of this so that this stands out a little bit better. Now, once again, you can see we've come into contact with that here. Here's our short setup. So basically, when we get that close below, we would measure the range out and then we would leave a limit order on here. If price gets to our first target, which would be here or probably below these lows, we would cancel it. If not, then ultimately we would say, okay, there's target one. We've got a good 2.21 risk to reward there. Pop that above the swing high a couple of pips. 2.71, ultimately targeting the inside bar low and then the mother bar low, right? And what we would do is we would just monitor this trade in the same way that we would take our entries, right? So we would look at this on a 15-minute chart and make sure that we're respecting the fair value gaps. So as we can see here, this is the first fair value gap. Does price violate this? Price just keeps getting held below it. We can actually see that price comes and engages with it here, which gives us another opportunity to get short. We can see a very similar breakdown pattern on the lower time frame. So does that make sense so far, guys? How we're looking for key levels, we're looking for liquidity to be attacked. If we don't see acceptance above that, we look at how price breaks down and then we look for a consistent entry trigger. All right, it sounds really, really simple, but actually I think overcomplicating trading can be one of the worst things to do sometimes, right? And I would really, really recommend anybody studies the correlation between time and price as well, because I think something that certainly a lot of students I've worked with over the time have kind of found quite frustrating is that they just sit behind the charts for just hours and hours and hours looking for setups. And that's a really dangerous thing to do, because you're trying to force your influence on the market or your opinion on the market. What you want to do is kind of zoom out like we've done here. And then in front of you, you've got your information that you need, right? So if we take a look at this here, and we'll clean this up in a second. But what have we got here? The inside bar pattern incidentally set here. So from this red box, or actually from this deviation onwards, we've got a tradable range. So we can just set alerts on these different levels. And then we say to ourselves, we favor the external liquidity, the key liquidity, yeah? While at the same time, we make a note of the internal liquidity as well, because if that fits with our trigger mechanisms, then it allows us to intraday trade. All right, guys. So I hope that was at least a little bit insightful. I do apologise if it wasn't clear for everyone, but we don't obviously have to just apply these to ranges, right? We can do this just with naked data. So I saw earlier Ricky just wanted to take a little look at Dogecoin. So I know we don't normally cover alts, but it might be a good exercise to show you on just a completely different asset, right? What we can do in terms of looking for these efficiencies, inefficiencies, levels, and how we can trade them. So if we look here, it's always nice when that happens. You go onto an old chart and some of the TA's work has obviously worked out, but we can see the exact same principles we were using here when we reviewed Doge, right? And actually, I think this was on last week's live stream on Wednesday. Yeah, it was. And this is what we were looking for, right? And I think this it did. This here, this exact arrow, none of this price action was here. It's fortunate that it's found this, but I'll tell you exactly why it has, because we were just targeting key levels, right? We were looking for a sweep below this low and for price to be supported by this bullish order block, right? If it didn't happen and we drove below this, right? This is the key thing to remember. You come down, you drive below this, and you retest it, well, then you're short down to the next fair value gap, right? That's what confirmation means to me, to go back to earlier, as we had a chat with a new member who came in as well, Lilbar. That's kind of why that means confirmation for me. So why were we looking at this? And we really went deep on this, right? Because when we zoomed out, we had this high time frame liquidity level, right? So the expectation was price got really close. Now, often what people will say is, it got close enough, now it's just going to sell off. And sometimes it does, right? Sometimes it does. But the fact of the matter is that if it doesn't, we need to retain our bias, right? So when we zoom out to a daily time frame here, we can see a lot clearer what we're targeting. This was the clear and obvious high, yeah? Why? Because it set this high and then it never came back up to take that liquidity. It just sold off, right? So then when we're now coming up to here and we're reversing here, well, if we're bullish, our expectation is to find higher prices, yeah? And now, as we can see on the daily, it's supporting our theory. Let's get rid of all that noise in the background. What's happening? Daily fair value gap being respected by price. Price moves on and attacks the liquidity resting above these highs. Hey, Craig, welcome, buddy. So, supported by a bullish fair value gap, our expectation is for price to attack liquidity at the highs. We're looking basically for price to either head for a fair value gap or head for liquidity, right? And liquidity typically is resting above old highs and below old lows. So price comes up. What have we got here? Higher low, higher high, higher low, higher high, higher low, higher high. We have to retain a bullish bias here on a daily scale. We absolutely have to. Then we drop down to our 4-hour scale and we look to refine the idea further. And this is what we did last Wednesday. We're saying when price rejected here, we expected price to find support within this 4-hour fair value gap here. And it didn't, right? We closed off our long positions that we were taking here. We've run liquidity above this high. Now price has failed to run this high and it starts to correct. No problem. Where do we look to? Well, we look to the inefficiencies, which is first of all this one. Price just starts meandering through it, yeah? So when we start we want to see price closing outside of this. But actually, we came straight back down into this bullish fair value gap here. And notice how the wicks may violate this, but the bodies have respected it. Yeah. So then all we're saying to ourselves is, okay, well, if we get a bullish fair value gap here, which we did, price came up, sets a bullish fair value gap, which is respected, then it's broken market structure via taking out this line, then we're bullish, right? We have a bullish bias because we have a bullish fair value gap here that we've targeted. Price has come down and held this, and ultimately we've then looked for higher prices, right? We would then put exactly the same theory across all of these. So we don't have a fair value gap in here. We have a very small one down here, right? So we would have marked this up in grey, so that's our FVG. The other important thing that we've got in here is this order block, right? So can we see how we've gone from a daily time frame, finding our fair value gaps, considering our market structure, giving ourselves our high time frame bias, which remains bullish through this whole section, the same way that we pick the trades within here. Now we're looking to this and saying, okay, well, look, we've clearly found support in here. So when we find that, what we simply do is we come back into this area, we look for confirmation. So if we want to go long there, yeah, Saturday, or we want to go long here, right, early Monday, or actually even here, as we come back into it, we can then drop down to a lower time frame, exactly as we did on the previous charts. And then we remember what we're looking for, right? We're looking for a level to be swept, which is this. Yeah, liquidity's taken below here. We look for price to set a high, low, high, higher low, break of this is our higher high, and then we look on the lower time frames for entry, right? We have a similar situation here. Even though we would have got our long trigger here, but there's nowhere to go long in here, right? We haven't had the sweep beyond this point. Price just continues to break down. Ultimately, where do we get the sweep? We get the sweep of that level there. We get the break of that level there. And this is where we get our opportunity to enter. Okay. So by taking it from a daily, decanting it down onto a 4 hour, and then refining it onto even lower time frames, that's how we can get our bias and look at our entries. And I just saw a little comment there actually from Ricky. Yeah, thanks. Check out those wicks. Yeah, absolutely. Wicks really, really tell us a story, guys. Really tell us a story. So with the current kind of geopolitical situation, which I don't really like commenting on, it's not my area of expertise, but I don't really like using war analogies. But this really is a good one, yeah? So when we're talking about candles, someone told me this once. I'm really apologetic to whoever it was because I can't remember who it was, but it was such a good analogy. You think of it like a battalion of soldiers, yeah? Or to just put a friendlier spin on it, let's think about toy soldiers, yeah? Or ants. You can, any kind of column-based. In fact, I could turn this story into ants, right? So what you've got here is you've got an exploratory team of ants, yeah? And when this candle's full, that makes up all of the entire battalion, right? Now, what's happened here is the battalion started here at the beginning of this candle, yeah? And progressed into enemy territory. Let's say over here we've got an opposing company of termites. For those of you that don't realise, I'm really digging into the ants film narrative here, right? So look, we've got this, right? Now what's happened here? If the full bullish extent of that had been imposed, what you would see is a very big bodied candle with a very small wick, yeah? What actually happens is the ants have desperately moved into there, but actually what's happened is they've then gained all that territory, but then they've lost it all again, and the termites have pushed them right back to here. So what does that tell us? It tells us this price tried to gain ground in here, but found a lot of resistance. What's the resistance it finds? It finds resistance from the sellers, yeah? From people saying, I don't give you acceptance above here. Let's always make things simple for ourselves, guys. Let's always go back to the simplest of analogies, right? Let's look at buying and selling at a market stall. It's all about supply and demand, right? If you have a great demand for a product, but you have very little supply, it increases the value of that product because too many people want it and not enough people have it. If you have the opposite, you have a product that isn't highly in demand, but there's a huge supply for it, it then means that it makes it a lot cheaper, Yeah. So it then means that basically the product devalues. So what happens here with price is saying, okay, I'm trying to get acceptance at this higher price. And people are saying, no, actually, I'm happier to sell here than I am to buy. Price comes down, normally reverts to mean, finds an equilibrium, and then it's a decision of, okay, is this the fair price? Is this the fair price for the item? In this case, Doge. In which case you tend to get ranging while price makes the decision, or the market makes the decision on whether the price goes higher or lower. All right. So wicks always tell us a really good story of this. Yeah. So price tried to get to here, but was forced back here. Yeah. So to me, we can see that as a sign of weakness. Hey, welcome back, Craigie boy. So we can see that as a sign of weakness. Yeah. Now let's look at the candle patterns that define these pin bar candles. Right. Now, I love a pin bar candle. So just to highlight these for you, let's take a very quick look at some of these, right? So by the way, guys, is that clear? Yeah. So we see price start here, tries to make that. If it was super bullish, it would hold that. Yeah. But actually it gets pushed back, right? That's why when we look at bullish engulfing candles, yeah. So when you see something like this, even you see this, the body of this candle engulfs this one. But look how there's no nose, yeah? There's no wick up here. That's just pure aggression and strength. That's just pushed price all the way out here. What does it closes here? Pushes up again, consolidates a little bit, but there's an acceptance that there's bullish strength behind it. We then get this candle that has that tail wick, and you can see the momentum is pushing price up. Awesome, 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 awesome. Brilliant, Erica, thank you, everybody else as well for listening to the ramblings. But what I would do is what I would say, is a lot of people would see this as a very bearish candle here because of the bearish body. But for me, if this closed like this, which it will do in 20 minutes, this would be a bullish pin bar. And what I draw your attention to here is this candle, right? Because look how it's basically the reverse of this. See how you've got that long tail wick and this fat body, and then you get a next bearish candle. See how price ultimately then sells off. We then get this long wick here, a nice, I would consider a bullish body. I know it's a bearish candle, but we've got a pin bar candle here, which means a long tail wick, a small head, and a minimal nose, meaning the bit of wick that sticks out at the end. Then we get a bullish candle here, and then here. All of a sudden, we can then plug that into our theory that price is finding support of this order block, that it's filling the inefficiency on the 4 hour, on the lower time frame, and then we're finding support here, and we can look to trade it higher. Okay, so that's where wicks and candles can really, really teach us a lot. And you can get these brilliant free indicators as well, guys, that show you pin bar candles, or that show you, inside bar patterns, or that show you engulfing candles, right? And it's a really, really good way to go away and look at the market dynamics, how it moves, how it breathes. But one of the things that I always recommend to any student of mine is to really hone your eye on any chart on any time frame by zooming out a little bit. And you can see it here actually on this example, marking up the key highs and lows. Do we get a reaction here? We do. So we can day trade this reaction or intraday trade it. Yeah. That means on a much lower time frame. And we say, okay, we've got a key sweep here. What happened? Price broke down, found support here, moved up to take liquidity again. Now, what's really different about this breakdown here to this one is that we would have been monitoring here high, low, lower, high, right? This is our break. So we're then looking for this fair value gap to offer us shorts, right? So then price comes into here. See, we wouldn't have got a short set up here. It breaks through it. What then happens is we then treat that as an inverse fair value gap. And then we can look for long trades off the back of it. Yeah. See how all these wicks, look at how the wicks respect this massively. Yeah. All downside wicks, no closes. We can then target liquidity resting above this high. Now, the opposite is true of this one. We did get a confirmed breakdown here. We got our sweep. Yeah, it's the same as we got here. We're now looking for our market structure shift or break. Here's our high. Here's our key low. Price takes out that, and in fact takes out this low as well, completely breaking market structure. So now we're just doing the same as we did here. So remember here, we monitored that, didn't we, to see if we got a bearish reaction, but we didn't. Price ripped through it, found support. Well, we can see here, price returns into it. It does not rip through it. We see the wick starting to form here. So when we get the breakdowns here, we can then target liquidity lower. Ultimately, this immediately, we've run through this, and then we would go on the lower time frames here to find reasons that price can reverse. We can be looking at order blocks, for example. Yeah. So we can say, okay, we're looking at the last high volume down candle here. I know some of these candles can look really, really big, but we're using them for monitoring purposes. Why this? Because this is the down candle that led to market structure break and ultimately a run on liquidity higher. So when price returned here, we expected a reaction. Returned here, we got a reaction. And here, ultimately, before we got that bullish move. Meaning that if we saw this starting to be violated and price closing and driving into it, it can give us a little bit of a hint towards our bias. All right. So again, I hope that's clear, guys. I mean, we can take this and you can put this on any time frame, right? Often these charts aren't really that hot on a 1 minute time frame, but let's just give you a couple of examples on an M5, right? And let's just go to just swish the screen to a random point and go, right, okay. If we're just looking at market structure here, there is no doubt that we're just bearish here, right? We set this big peak and price was breaking down. So all we're doing, no matter the time frame that we're on, and this is obviously not allowing for price, for time and price, which I do. So within the New York trading session here, if I'm bearish, I can just look within these blue lines. Why am I bearish? Because we've rejected at this high time frame order block and level. If we were bullish, I would expect price to find acceptance above it. It doesn't. It breaks down. So ultimately, I'm looking to play weakness. I'm looking to trade with the trend because we've established our high time frame levels and bias. And now we're just looking for our entry signatures on the lower time frame, which are exactly the same. Yeah, we're looking for sweeps. We're looking for shifts in market structure. Yeah, and then if we're using typically the principle that I use, right, which is premium discount range, then I'm just looking for an inefficiency within that range, or say a breaker. Yeah. So as I gave you the previous example on a breaker candle, I'll give you this example on a breaker candle as well. That would have been our breaker entry. Yeah, remember we want to be in the top 50% of the displacement leg, which is the leg that breaks down here and recovers. So that's our breaker entry. If we zoom in a little bit more, we can see that we had a fair value gap here as well, right? Very thin one here, which I'll just do in black so it stands out a bit better. Yeah, we had an order block in here that we could have targeted, or this one down here as well. Ultimately, we know that we're searching for liquidity in a couple of places here, right? Below clean lows, and when I say clean lows, unswept, 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 right? You'll see me do this on a chart sometimes, which just means that there's money under there. It means that quite often, you can imagine algorithms and that targeting this area in terms of liquidity. Ultimately, we can see that even though price chopped around a bit here, it was drawn down to this key area and then actually deeper down into this. But once we took all that liquidity, we can see over here, we got a reaction. However, remember, we don't want to just be trading reactions. We want to have that high time frame context. And what is that context? Well, the context is simple. We're still bearish. We've had no break of structure to suggest that we're going to become bullish. Yeah. So, lower lows, lower highs, lower lows, lower highs, etc. Right? All the way down to here. So when we get this bullish reaction, what makes us turn bullish? We would need to see a significant break in structure. Here's our fair value gap. Anytime price engages with this, we are bearish, right? However, we wouldn't be bearish, would we? If price ripped through this, retested it, and then we could look for higher prices. But we've got our plan. We've taken our high time frame plan, we've put it onto a medium time frame, we've now decanted it onto a low time frame, we've added in the element of price and time. So we're now within our New York trading session. We have a bearish bias. We have a perfect target because price has run into this fair value gap. We're showing resistance here. So anywhere within here, we get a sweep followed by displacement. Yeah. So remember, all of these things are the same, all based around displacement. Here's your displacement, right? So you've got highs up here. Take your pick. We've had a sweep of these highs. We now need a shift in market structure, which we get here. And in that shift, the close below, do we get a fair value gap? Yeah, which we do here. Or after that shift, just to show you, just to not cherry pick, right? But this would be our breaker candle. So we'd be looking for the last kind of high volume down candle before that run on liquidity. I would say that you're probably saying that that's the origin of that move, right? You take that across, that becomes your breaker, that becomes your entry. Your stops go above the swing high that's above the breaker. Yeah. So we've just determined that price is pulling back to a bearish fair value gap, and now we're looking to find that bearish trigger. We don't want to just jump on board anywhere. We want to see a sweep on liquidity, and then we want to see a breakdown. Yeah. I would have ideally liked to have seen, you could make an allowance for this one. So you've got a sweep. This does break structure. I like to see a close in truth, but we did have an inefficiency in here. It wouldn't have been in our 50% range. All right. But we've got this here. The other thing that we could have targeted in here as well, right, is we've got these two fair value gaps, right? So we could have targeted that as an entry as well. I really, really will, and I'm going to write it down on my list at the moment. Entry trigger thread. When I promised this to get this done for a little while now, it's just not really got round to it. But I have pinged that on there because I think that maybe gives people a little bit more confidence. So for me, daily, 4 hour, hourly, or 15-minute, keep telling that story of price. Find these key areas to target. I set an alert in here that triggers to make sure that I know where price is at the time my trading hours start. I trade the New York London Open, right? So, for example, what would we be looking for here in London, right? We would have wanted this to sweep. If I was trading London, this is how it would have looked. See, we get our sweep here. Yeah. We then get price come down to here. See how we broke here? See, we just closed below. Right. And then ultimately, I'm either looking for the breaker, as we said before. So we take the candle here. This is a tricky one, actually, because you could argue maybe that's the breaker before that purge higher. And we wouldn't have got a retrace into an FVG here. Yeah. So we might not have actually got an entry for that one. But technically, we can see that because we're on the right side of order flow, because we've got a right side of bias, we can see that we're kind of finding these setups. You won't always get the triggers and they won't always work. You've got to accept your losses in trading, right? That's why I love, I share as many losing setups as I do winning setups, because I'm probably in and around the kind of 60 percentile for wins because I'm a lower time frame trader. But someone like Berb, for example, can win 30% of his trades and still be super, super profitable, right? Because he's a trend and swing trader. He understands that he's going to get more wrong than right, but he also understands that his winning percentage, like his risk to reward on his winners, is huge. So takes multiple small losses but books big winners. All right. Couple of questions, guys. Let me just run through because I know I've been going on for quite a while. Lil Bar. Awesome, bud. Well, look, if you've got any questions, you can reach out to me at the Nest, guys. If you do want, you can sign up for a trial. I think you can get access now to try us out for $1 or something ridiculous like that. You can get access to our calls through our partners Bybit, but you can also reach out to me on Twitter as well, guys. Yeah, good to see you back, Craigie boy. Nick, awesome. Okay, yeah, glad that's clear. Thanks, Erica, as well. And MM as well for that. Smash the likes. Yeah, guys, if you do enjoy the content, please do hit the likes. It does help us out. Yeah, okay, good question from Nick. Awesome, mate. Really good analysis. Thank you. So would you enter the trade at the breaker? Yeah, so for this trade example, for this one here, I've got my sweep and I've identified the down candle that led to the sweep. So then I wouldn't enter here. I would need a close below this. And in the move that takes out the breaker, for me, I need to see an energetic move leaving displacement. And that means leaving these fair value gaps. Yeah. So just for those people that maybe don't have a lot of experience with FVGs yet, we're talking about these gaps here. 3 candle pattern, and we're looking for the gaps. And again, we can see on the low time frame, what do we expect from a bearish fair value gap, which is this. We expect it to reject price. Yeah, and we can see here it rejects it. But for me, focusing on the breakers, I need a strong close below. When this candle closes here, my limit order opens here. Right, and like I said, my stops go above the swing high, that took out liquidity. So the swing high that precedes the breaker being violated. You could get aggressive with this one because you get a secondary high set here. Yeah, crypto can be quite volatile, so you can get taken out. But what I would always recommend, if I can speak today, is to just make sure you go away and test this data. Lovely. The good thing about this one is you've got this really beautiful kilo to target down there, and that ends up being a nice 4.7R trade. But to set the breaker, I need to know the down candle that led to the purge on liquidity higher. Yeah. And then when we get the close below, when that closes, we then put our limit order here, our stop loss above here or above here. Yeah. And then we've got clean targets down below. All right. If you wanted an interim target, because there isn't anything overly clear here, I'd probably say this down candle before price moves up. So you'd want to make sure that you've got, for me, I'd want to make sure that my first target has got at least a 1.5R. Yeah. So if that was the case and that was your principle, then you'd need that target to be that. However, here, I think the really clear and obvious one is this or possibly lower. All right, guys. So I hope that's made a bit of sense. GOT. Okay, so when you refer to time, you mean the actual time of day of week? Yeah, no, exactly right. So you're exactly right, mate. Yeah. So what I'm referring to here are what are known as kill zones. Yeah. So it's a set of time and price principles that have been put forward by a few different traders, but the most prominent of which is ICT, the Inner Circle trader. I was very fortunate to study under his original mentorship many years ago. I know he's got new content since. Someone I recommend everybody checks out. Just a very, very good understanding of algorithmic price delivery and how you can kind of spot that in price action. But yeah, exactly right. So for me, my sessions are, I can open these up for you and you can take a look. So this is all in New York time because that's how the session indicators transfer them over. So the London session, for example, here we can see starts at 2 a.m. till 5 a.m. if you're New York. But for me, that's 7 a.m. through to 10 p. till 10 a.m. That's my key kind of area that I'm looking to trade. The London session. Yeah. So in this case, I've got a bearish bias. So what do I want to see? I want to see price move higher to take out liquidity before breaking down and targeting liquidity lower. My same principles arrive when I get into the New York session, which for me, UK time is 1:30 in the afternoon. And I trade that through, as you can see here, until 10 p.m. Yeah. And then I'll refine macro times within that I like to see particular triggers. And for something like that, I'll use just a line-based indicator. So, for example, you've got this one here, which is CM time-based lines. Yeah, and they don't project on weekends, right? They project Monday to Friday. And these are going to be slightly off here because these are currently set for the Forex markets. So just to give you a little example of that, let's take a look at one of our Forex pairs. What was I looking at this morning? Aussie dollar. So this is the Australian dollar versus the US dollar. Trading FX markets is really, really interesting, kind of has a little bit more of a fundamental value base to it as well. But really important times for me when I'm trading these assets come here, right? So this is 2:30 in the afternoon is the first trigger point, and then 3:30 in the afternoon. Now I'm looking for setups that trigger within here or up to 30 minutes before. Yeah. So we can see here, same thing. This is where we took our short setup, ultimately attack the stops resting below there. And then as we go back, it's all about studying this and saying, okay, do we get these reactions here? Bearish bias, why? Because we're below this purple high time frame inverse fair value gap. Yeah, that's why I always color purple. Price breaks down. We look for our array here, which this was a high time frame order block, this black line, and this was our medium or lower time frame fair value gap. Price reaches into here, sweeps liquidity, breaks down. We get a low time frame retrace of this FVG, and we take out the stops below this low. Yeah. So just to give it a little bit of context, that's how I look in terms of time and price. So for me at the moment, London session, we held this H4 order block, which gave us a good reaction here. Look, we had this breakup, we held this. Yeah. So I was long biased this morning on Aussie dollar, US dollar, purely because with our London session, we had the sweep, we got the break, price returned in here to this small fair value gap and gave us our long. So whether you're doing this on FX markets or crypto, that's the way. But yeah, again, I'm certainly not going to enforce on anyone what my times are that I study and that, but I do recommend going to the source, which is ICT on that, and making sure you just really, 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 really test the data, guys. All right. Oh, okay, Nick. I'm really sorry, mate. I missed that. Was that on Doge? Let me know if that's on Doge, and I'll have a little bit look. Carlo, hey, buddy. How are we doing, my friend? Good to see you. So yeah, Nick, good question. So you're talking about getting these kind of stop outs. It's very difficult to stop them entirely, but if you ask yourself a question of where's the clear and obvious run on liquidity, yeah. So if we've got this order block here, we've got this low here, we've got these lows here, right? Now, if we're looking to trade here, right, yeah, we get a little run on liquidity here and price kind of comes back up. But is this not a much more obvious move? How the market's manipulated aggressively here. And actually, you can pop your volume on help sometimes as well, right? Don't worry about whether it's bearish or bullish volume. You see this? See how price kind of just peaks up here? What's it pointing to? This wick. Yeah? What does that mean? Well, it means that if our theory is that we're expecting a reaction here, yeah, and that actually price has now come down, swept these lows, come into a bullish order block, yeah, we've had this strong reaction under high volume, low, high, break of this high here, especially this high here, we leave this order block. Price now comes back within our order block, yeah? So then what we're looking for is the same thing. Sweep on the lows, price to break the high, inefficiency within here, gives us our entry, stops below the low, targeting this high, which we've just taken out here, right? They're the kind of very basic stripped down principles of liquidity, right? But what we also want to do is obviously put a high time frame bias in there as well, yeah? But actually, when you're looking for these points, Nick, sometimes including a bit of volume data, yeah? So we look up here, we take that volume data up here. Yeah, it's because of this really big drop here, but we could have targeted this fair value gap here for a retrace. Unfortunately, we didn't get it, but perfectly legitimate setup. What do we get here? We get this first warning sign that the volume is changing here. What happens, right? We come back up, leave this inefficiency in here. The price comes back down to fill, but ultimately we didn't break market structure, which isn't a problem because that can save us sometimes, right? Because we would have had a short-term scalp before price reversed. But if you want to pop across and give me an example on that 1700 one, mate, I'm happy to pop back to the Doge chart. I typically keep the volume off the chart just because I find it a little bit cleaner, but I always turn it on. If I'm looking for a reaction here, like, exactly like I said, I know I just deleted it, right? But sweep, break of market structure, return to a trigger mechanism that sits within discount, yeah? And we've got a clean high time frame target here, which we've just tagged, yeah? So this trade would look something like this. We would have come back down. Where's our order block? Our order block's actually a bit lower. Our fair value gap's a bit lower. It's there. That's the trade to here. Nice 2.6R trade, yeah? But again, see when we get the sweep, see this nice high volume bar here can help give us the confidence that then when we see that break of structure, that we've got a little bit of extra confidence behind us. Touche, my friend. How are you doing? Good morning, brother. Who else we got on here? Nick. Yeah, it was Doge, but it was more about limiting the possibility of getting wicked out. Okay, perfect. Yeah. So really, what you want to do is you just want to really understand where that purge on liquidity is happening, and a lot of that comes from kind of our high time frame bias as well. GOT just got through the ICT Primer course. Nice. Next up, 2022 mentorship. Yeah, packed full of alpha. Make loads of notes, take it apart. Don't believe anything you ever hear from anyone, including me. It's not saying I'm lying to you, but what I mean by that statement is go away and validate it yourself. Yeah. Make sure when you hear these things, don't just go and try and implement them straight away. Study them. Be obsessive about the data. Yeah, and really, really push forward into that. So, guys, on that bombshell and finishing on a little bit of FX for a difference, I hope that's been really helpful. We're going to call it a day there, pitching it on literally 30 seconds away from an hour. I'm going to try and make these a little bit shorter going forward and maybe consider doing a few more videos for you guys so that it's a bit more digestible. But ultimately, I really hope you found that useful. It's really good to see you as well too, Shay, and everybody on the stream as well. Huge amounts of people in today, really, really helpful. If you've got any questions on this, guys, come and grab yourself a free trial membership at the Nest. Come and speak to me myself. I'm not the only trader on there. I've got some unbelievable, trading team around me. I'm very fortunate to have that come and draw on our experience. And you can reach out for me on Twitter as well. All right, guys. Hans, great to see you as well. Love the comment on Twitter this morning as well. So look, Ricky, you're very welcome, mate, as is everybody that was on the stream today. We're going to be back again on Wednesday. So we're going to do our alt request Wednesday. Yeah, so we're going to take a deep dive into that. Also, we can look at FX pairs. So if you have got some, do let me know. We'll really dive into some charts, see if we can find some setups. And then as that transpires, we'll maybe look to do some live trading in the afternoon on Wednesday as well. I'll show you some of the lower minute charts that I'm looking at and see if we can find some nice setups together. All right, guys. Have a fantastic week. Trade safe. Remember that, time behind the charts is one thing, but make sure that you're using that time wisely in terms of educating yourself, having a structure around what you learn. Appreciate the discipline you want to go into and learn about it obsessively and test everything obsessively. It's the very best way to build consistency. All right, guys, have a fantastic week. I cannot wait to see you on Wednesday. All the best. I'll see you soon.